Silver futures have reached a significant milestone, with Western futures closing at $94.30, a level that market watchers had previously identified as the next key technical objective. This development comes amid a broader rally in precious metals that analysts say is drawing considerable attention across global financial markets. Silver has now recorded 10 consecutive monthly green closes, a streak of sustained upward momentum not seen since the historic run into 1980, when silver climbed from $6 to $50 per ounce over an 18-month period. Gold, meanwhile, has posted its 7th straight monthly record close, the longest such streak since 1973, with Western spot gold currently trading at $5,277. In just the first 2 months of this year, gold has risen 22%, while silver has gained 31%. These figures represent some of the most notable short-term performance data recorded in the precious metals space in recent decades. At the same time, oil, gold, and silver have been moving in tandem, a pattern that market participants say carries particular significance. When hard assets across energy, monetary hedging, and industrial metals sectors advance simultaneously, it is widely regarded as a signal that markets are pricing in elevated geopolitical risk. An estimated $650 billion was added to the precious metals market capitalization as geopolitical tensions escalated during this period. Alongside these price movements, notable structural developments have emerged in both Eastern and Western markets, including a significant Shanghai premium on silver and shifts in futures market open interest, raising questions about the relationship between physical and paper pricing mechanisms. Coming up, we will break down the specific market data, the geopolitical factors at play, and the structural shifts now being observed across silver futures exchanges. One of the more striking developments in the current precious metals landscape is the significant price divergence between Western and Eastern silver markets. Western spot silver is currently trading at $93, while Shanghai spot silver is priced at $105, and Shanghai futures are sitting at $108. That represents a Shanghai premium of approximately $12 over Western spot prices, a gap that has continued to widen even as prices climb. Market observers note that when the premium between physical and paper markets widens in this manner, it suggests that Eastern and Western markets are, in effect, pricing two entirely different realities. The widening Shanghai premium, occurring simultaneously with rising prices, is being interpreted as a signal that physical silver demand and paper silver markets are increasingly disconnected. On the geopolitical front, several developments unfolded in close proximity to these price moves. United States President Donald Trump publicly stated that he was unhappy with the pace of negotiations with Iran. Subsequently, the United States State Department issued a statement indicating that Iran had begun taking Americans hostage, calling on the Iranian regime to stop detaining Americans and to release all those unjustly held. Separately, China issued an order for its citizens to leave Iran immediately. These developments coincided with the $650 billion addition to the precious metals market capitalization referenced earlier. Market participants have pointed to the simultaneous movement of oil, gold, and silver during this period of geopolitical tension as consistent with how markets historically price tail risks. Scenarios involving potential oil supply disruptions, shipping route closures, and currency depreciation, before such events fully materialize into confirmed outcomes. Turning to the structure of the futures market itself, data from the Chicago Mercantile Exchange vaults also drew attention during this period. The February 26th vault report showed that Comex registered silver rose by 2.3 million ounces, bringing the total to 88.4 million ounces. Among the individual vault movements, HSBC added 824,000 ounces, Loomis added 964,000 ounces, StoneX added 307,000 ounces, and Brinks added 111,000 ounces. However, eligible metal, silver held in Comex vaults but not yet designated for delivery, fell by 2.6 million ounces to 272 million ounces, resulting in a net outflow of 306,000 ounces. Total Comex silver across all categories now stands at 360.3 million ounces. Beyond the vault inventory figures, perhaps the most closely watched development in the Comex silver futures market has been the sharp decline in open interest. Open interest on silver futures has collapsed from 162,000 contracts, approximately 1 month ago, to 118,000 contracts at present. That represents a drop of 27%, and critically, this decline has occurred while silver prices were simultaneously climbing from the $80s to $94. This combination of falling open interest, alongside rising prices, has drawn scrutiny because it runs counter to what would typically be expected in a straightforward bullish futures rally. In a conventional rally driven by new long positioning, open interest would generally be expected to rise alongside price. The fact that it is falling instead has led to observations that the participants exiting are commercial hedgers, not speculators taking profits on winning long positions. The explanation being offered is that commercial hedgers and dealers are migrating away from Comex toward over-the-counter markets. The reasons cited include higher Comex margins, deteriorating liquidity conditions, and execution difficulties on the exchange. High-frequency trading activity has also been identified as a compounding factor, with such traders described as arbitraging multiple angles simultaneously in ways that have stressed the exchange's market structure. It is further noted that earlier in the week, the Chicago Mercantile Exchange experienced technical issues, and that the vault report data followed shortly after that halt. The downstream consequences of this structural stress are also being outlined. When dealers are unable to hedge effectively on an exchange, their ability to manage balance sheet risk is compromised. In response to weakened balance sheets, some dealers may compensate by widening spreads on retail transactions, charging higher premiums on purchases and offering lower prices on buybacks. This is described not as deliberate misconduct, but as the predictable behavior of businesses operating under financial stress. A separate caution has also been raised regarding storage arrangements for physical silver holders. When a dealer offering low or free storage is simultaneously the entity offering to buy metal back, a structural conflict of interest exists. The concern is that investors storing metal with their own dealer may encounter unfavorable buyback pricing or extended payment delays when they choose to sell. The recommendation offered is to keep storage and purchasing decisions separate and to seek custodians who are not simultaneously acting as dealers. Adding further texture to the picture of market stress, silver lease rates have risen to 1.6%. This is a notable shift from an average of positive 0.04% in 2023 and negative 0.18% in 2024. Lease rate spikes of this nature, occurring alongside widening premiums and collapsing open interest, are being interpreted as indicators of declining confidence in paper delivery systems. Taken together, the data points emerging across precious metals markets paint a detailed picture of an environment undergoing notable structural and price-driven change. Silver has now closed at $94 following Western futures settling at $94.3, fulfilling a previously identified technical objective. The 10 consecutive monthly green closes for silver and gold's 7th straight monthly record close, representing its longest such streak since 1973, are being cited as historically significant milestones by those tracking the precious metals space. Gold's current Western spot price stands at $5,277, with gold up 22% and silver up 31% in just the first 2 months of this year. These figures place the current rally among the more notable short-term performance periods on record for both metals. The simultaneous movement of oil, gold, and silver during a period of documented geopolitical escalation, involving Iran, the United States State Department, and China's citizen evacuation order, has been identified as consistent with how markets historically price elevated risk scenarios involving energy supply, shipping routes, and currency stability. On the structural side, the $12 Shanghai premium over Western spot silver prices continues to signal a divergence between physical and paper market pricing. Comex open interest has declined 27% over the past month, dropping from 162,000 contracts to 118,000, even as prices climbed. Eligible silver in Comex vaults fell by 2.6 million ounces, resulting in a net outflow of 306,000 ounces, with total Comex silver now standing at 360.3 million ounces. Silver lease rates have moved to 1.6%, a sharp contrast to near zero and negative averages recorded in 2023 and 2024, respectively. The collective movement of these indicators, rising prices, widening Eastern premiums, collapsing futures open interest, declining eligible vault inventory, and spiking lease rates, is being presented as a set of verifiable, publicly available data points that market participants can independently examine through Comex reporting, Shanghai exchange data, and historical price records. The broader context offered is one of structural fragility built over time through sustained market interventions, with the current environment reflecting the accumulated pressure of multi-year supply deficits, geopolitical fragmentation, and central bank buying activity. The emphasis throughout is on independent verification, encouraging market participants to consult primary data sources directly, including Comex vault reports and Shanghai premium figures, rather than relying solely on secondary commentary. The core message being conveyed is one of disciplined, data-driven decision-making, that understanding the difference between short-term price action and longer-term market thesis, recognizing sentiment extremes, and maintaining awareness of structural conflicts of interest in storage and dealing arrangements are all essential components of informed participation in precious metals markets. That concludes this broadcast report on the current state of silver and gold markets. All figures and data referenced in this report are drawn directly from the source material as presented. We will continue to monitor these developments as further information becomes available.